Jamie Dimon just said something big is coming. Not inflation, not a recession, a crack in the US bond market. And he's not guessing. He's warning regulators, investors, and global allies that this time, the system might bend too far to snap back. Let's unpack what he said, why it matters, and what it tells us about the next major financial risk hiding in plain sight. Dimon is the CEO of JPMorgan Chase, the most important bank in the world's financial system. His firm clears trades, holds treasuries, manages global liquidity, and regularly meets with presidents, central banks, and regulators. So when he speaks like this, it's not a hot take. It's a pressure gauge from inside the machine. At the Reagan National Economic Forum, Dimon said, "A crack in the bond market is going to happen. I just don't know if it's in 6 months or 6 years." He points to $10 trillion in U.S. deficit spending since 2020, and $8 trillion in Fed balance sheet expansion. He says the structure of the bond market simply can't handle that forever. Since the 2008 crisis, rules like the supplementary leverage ratio have made banks safer, but they've also made treasury markets thinner. Banks now avoid holding too many treasuries because of capital requirements. So in moments of stress, there aren't enough buyers to catch a falling market. Dimon's view? We tried to make things safer and instead made it brittle. If you like content that breaks down the big risks others ignore, consider subscribing. We post weekly, clear, focused, and fast. This is Global Notes by JP. Of course, people ask Dimon about geopolitics, and for good reason. He's more than a banker. He's an informal advisor to global leaders. This time, he said something subtle but serious. If U.S. allies can't rely on American military support, they'll look for alternatives. And there's only one. He didn't say the word, but he didn't need to. Only China has the scale to offer an alternative global framework. This isn't about conflict, it's about alignment. And Dimon sees that trust eroding. Dimon wasn't just looking outward, he pointed inward. He warned that America's greatest threat may be the enemy within. Political dysfunction, gridlock, declining institutional trust. And when markets lose confidence in leadership, not just monetary policy, cracks appear faster than anyone expects. Dimon isn't just sounding alarms, he's proposing reforms. Top of the list, tax-carried interest like ordinary income. Here's why. Today, private equity and hedge fund managers earn massive profits, called carried interest, by managing other people's money. But they pay just 20% in tax thanks to a loophole that treats this as a capital gain. Dimon says that's wrong. If you didn't invest your own money, you shouldn't get a discount. He wants to close the loophole and redirect the estimated $60 billion in tax revenue to double income tax credits, not just for families, but also for individuals without children. It's a bipartisan fix. Tax fairness at the top, support at the bottom. Dimon isn't predicting a 2008-style crash. He says what's coming might look like a kerfuffle, a small dislocation in the treasury market that forces a major Fed intervention. But behind that word is a real message. If we don't fix the cracks now, we'll be forced to later. Under pressure and at a higher cost. The U.S. Treasury market is the foundation of global finance. If it breaks, the ripple effects hit everything. Mortgage rates, business loans, equity valuations, global risk appetite. Dimon is saying the quiet part out loud. We're relying on a fragile system and pretending it's fine. Jamie Dimon has already warned us about stagflation, dollar risk, and deep market fragility. We covered all of that in our previous video, and it's linked in the description if you want to see how this warning connects to a much larger shift. If this helped you see the bigger picture, consider subscribing. We keep it simple, clear, and grounded. No hype, no panic. This is Global Notes by JP, where macro meets clarity.